Today we're doing a complete breakdown of IAS 12. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a company with $100 million in assets and no clear tax liability on its books due to complex deferral strategies. IAS 12 addressed this by mandating clear reporting of deferred taxes, making financial statements more transparent. After this section, you'll understand how deferred taxes impact financial statements and why transparency is crucial. Before IAS 12, companies used different methods to handle taxes, creating murky financial statements. The standard introduced a consistent approach to recognizing tax impacts, ensuring clarity. With IAS 12, companies must report deferred taxes, making financial information more reliable. This change significantly enhances comparability across companies, aiding investors in making informed decisions. All companies using international financial reporting standards must adhere to IAS 12 since 1998. The standard requires them to recognize deferred tax liabilities for taxable differences and assets when future profitability is likely. This rule ensures taxes are acknowledged accurately, minimizing surprises. By understanding this, you'll grasp how companies prepare for future tax obligations and the impact on their financial health. The deferred tax model is pivotal in financial reporting, aligning accounting profit with taxable profit over time. It requires recognizing temporary differences between book and tax values, ensuring transparency about future tax impacts. For example, a company capitalizing equipment may defer taxes. Mastering this model not only clarifies financial statements, but is a valuable asset in finance interviews, showcasing depth in accounting knowledge. Understanding the scope of IAS 12 is crucial in practice. A common pitfall is assuming that non-income-based taxes like VAT fall under this standard. That's an interview classic. Knowing what's included and excluded can save you from costly mistakes and help you shine in job interviews. IAS 12 focuses on income taxes payable and receivable, crucial for determining tax positions in financial statements. Deferred tax assets arise when taxable income is less than accounting income, offering future tax relief. Deferred tax liabilities appear when taxable income exceeds accounting income, indicating future tax payments. Temporary differences between asset or liability carrying amounts and their tax base also fall under this standard. IAS 12 explicitly excludes taxes that aren't income-based, a detail often missed in interviews. For instance, VAT is transactional and not covered here. Customs duties and excise taxes also don't fall under this standard, as they aren't related to income. Remember, these exclusions are classic traps. Knowing these can prevent costly mistakes and set you apart in interviews. Deferred tax assets are a future tax benefit that occur when taxable income falls short of accounting income. Consider a company with a $100,000 tax loss carryforward. It expects future profits, so this loss becomes a deferred tax asset. Recognizing such assets depends on anticipating future taxable profits to utilize these benefits, a strategic advantage when planning tax positions. Deferred tax liabilities represent future tax obligations when taxable income surpasses accounting income. Imagine using accelerated depreciation on a $1 million asset. Tax payments are postponed, creating a deferred liability. Such liabilities emerge when income is recognized earlier for tax purposes. Recognizing them involves understanding temporary differences that will reverse, impacting future tax positions and cash flows. Navigating IAS 12 requires clarity on edge cases. For instance, VAT on imports is transactional, not income-based. Similarly, customs duties don't relate to income, nor do property taxes, so they're excluded. Conversely, deferring tax on a capital gain, which impacts taxable income, falls under IAS 12. Understanding these nuances is essential to mastering the standard and acing interviews. Every business faces the challenge of aligning accounting profits with taxable profits. The deferred tax model under IAS 12 is crucial for managing this alignment. Consider a company with a $10 million contract. timing differences can significantly impact tax liabilities. Understanding this model ensures accurate financial reporting and tax planning. The deferred tax model is essential to ensure that financial statements reflect the true tax position of a company. Using Meridian Corporation's $10 million SaaS deal, we'll see how each step, identifying temporary differences, applying tax rates, and adjusting balances, works to prevent mismatches. By the end, you'll understand how deferred tax impacts both financial position and tax strategy. Meridian Corporation's $10 million contract involves software and services. Here, we'd compare the carrying amount of the software license to its tax base, revealing a $1 million temporary difference. This step is crucial because missing such differences can skew deferred tax. Many dismiss this as simple, but International Financial Reporting Standards expects a thorough analysis. That $1 million difference will now guide us in determining applicable tax rates. With Meridian Corporation's $1 million temporary difference, the next step is to apply the correct tax rate. If the corporate tax rate is 30%, this results in a $300,000 deferred tax impact. Misapplying rates here can lead to significant reporting errors. International Financial Reporting Standards insists on using the exact rate for accuracy. Understanding this ensures that the deferred tax liability or asset reflects the true tax obligation. Continuing with Meridian Corporation, we've identified a $1 million temporary difference and applied a 30% tax rate. This leads us to a $300,000 deferred tax liability. Mistakes often occur when adjustments for tax credits or allowances are missed, skewing results. International Financial Reporting Standards stresses considering these factors to align deferred tax with future benefits. Now, we'll focus on recognizing this in financial statements. With Meridian Corporation, the $300,000 deferred tax liability should now be recorded, ensuring it appears accurately on the balance sheet. Misclassification as current rather than non-current can distort financial metrics. International Financial Reporting Standards directs that deferred tax follows the transaction's equity or income component. This precision ensures stakeholders see a true reflection of the company's fiscal health. Next, we'll review and adjust this balance as needed. Finally, Meridian Corporation must review its $300,000 deferred tax liability regularly. Changes in tax rates or asset values could necessitate adjustments. Often, companies overlook this, leaving balances outdated. International Financial Reporting Standards demands annual reviews to ensure deferred tax reflects the latest tax environment and business realities. Maintaining this vigilance guarantees that all tax-related financials are both current and correct, safeguarding against potential compliance issues. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. IAS 12 requires you to disclose deferred tax assets and liabilities separately, ensuring transparency. Discover the nuances of measurement choices and essential disclosures that help in accurate financial reporting. When recognizing deferred taxes, timing is crucial. You must identify a deferred tax asset or liability when a temporary difference arises. If future taxable profits are probable, recognize a deferred tax asset. Otherwise, it's a missed opportunity. Use enacted or substantively enacted tax rates for initial measurement, ensuring your financial statements reflect accurate tax implications at the balance sheet date. Ongoing measurement ensures your financials remain accurate amid changing tax landscapes. Adjust deferred tax values for any tax rate changes, a common occurrence in evolving economies. Reassess whenever new tax laws emerge or when new information surfaces. Regularly verify that deferred tax assets remain recoverable in future periods, maintaining a realistic view of your tax position. How you present deferred taxes can influence stakeholders' perception of your financial health. Deferred tax assets and liabilities are shown as non-current items, reflecting their long-term nature. The income statement captures tax expenses, offering a clear view of tax impacts on net income. Use notes to detail temporary differences, enhancing transparency. Offsetting is permitted only when legal enforceability exists, preventing misleading net positions. IAS 12 emphasizes transparency through disclosures, vital for investor analysis. Detail deferred taxes for each temporary difference, aiding in understanding tax impact. Explain how changes in tax rates influence deferred positions, allowing stakeholders to anticipate future implications. Reconcile effective tax rates with statutory rates, revealing any variances. Finally, unrecognized deferred tax assets need explanation, providing insight into unrealized potential and strategic tax planning. Imagine a CFO managing deferred taxes with precision. A $2 million deferred tax asset is recognized based on likely future profits. When tax rates increase by 2%, prompt adjustments reflect the change. The CFO's judgment reassesses recoverability, ensuring assets aren't overstated. Legal enforceability allows offsetting, refining the company's net deferred position. This scenario exemplifies the strategic role of deferred tax management in financial accuracy and investor confidence. Meridian Corporation, a global manufacturing company, enters a complex tax arrangement in Germany involving deferred tax liabilities. See how these transactions are recorded, adjusted, and ultimately resolved. This journey shows the practical application of IAS 12 in a real-world context. IAS 12 requires Meridian Corporation to recognize a deferred tax liability when taxable temporary differences arise. This recognition aligns future tax payments with current financial performance. By crediting $500,000 to deferred tax liability, Meridian prepares for future tax expenses, enhancing the transparency of its financial health. Identifying deductible temporary differences allows Meridian to record a $300,000 deferred tax asset. According to IAS 12, this asset reflects future tax benefits from these differences, improving current period earnings through an income tax benefit and enhancing predictability in future tax savings. Tax rate changes directly affect deferred tax calculations under IAS 12. By adjusting $50,000 between the deferred tax liability and asset, Meridian ensures its financial statements accurately represent future tax obligations and benefits, facilitating better financial planning and investor confidence. Annual reassessment of deferred tax positions is crucial. It incorporates changes in taxable profits and tax laws, ensuring financial accuracy. By adjusting $20,000 in deferred tax asset, Meridian aligns its financial outlook with reality, crucial for compliance and strategic decision-making under IAS 12. Utilizing a deferred tax asset against taxable profits reduces current tax liabilities, optimizing cash flows. Meridian's $100,000 utilization decreases tax expense, showcasing strategic tax planning under IAS 12. This move enhances net profit, reflecting the foresight in managing deferred tax assets. Settling $150,000 of deferred tax liability requires cash payment, a critical part of managing financial obligations under IAS 12. By reducing this liability, Meridian matches previous accruals with actual cash outflows, maintaining credibility and ensuring the balance sheet reflects current obligations. De-recognizing deferred tax balances is pivotal as transactions conclude. By adjusting $50,000, Meridian closes the loop on its tax obligations, ensuring the balance sheet's accuracy. This move highlights the closure of tax cycles and prepares Meridian for future financial planning under IAS 12. Every Big Four and investment bank interview on IAS 12 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. IAS 12 addresses income taxes, specifically current and deferred tax. It ensures that tax expenses align with accounting profits. Imagine a company with $100,000 profit, but owing tax next year. Common mistake: ignoring deferred tax liabilities. Remember, it matches tax impact with financial results, essential for true financial health insight. Deferred tax assets arise from overpaid taxes or future deductible amounts. They help companies reduce future tax liability. Imagine carrying $20,000 forward to offset profits. The trap: confusing these with liabilities. Grasping this means understanding how financial statements reflect future tax benefits, a strategic edge. Adjust deferred tax to reflect new rates immediately. Say the rate drops from 30% to 25%. Recalculate deferred assets and liabilities. Overlooking this can misstate tax expense. Always align deferred tax with enacted rates to ensure accurate financial statements reflecting current tax obligations. Revaluations impact deferred taxes by changing the tax base. If a machine's book value rises but tax base doesn't, create a deferred tax liability. Ignoring this can distort profits. Key takeaway: always reassess deferred taxes with asset revaluation to reflect true tax obligations. The primary difference is recognition criteria and offsetting rules. Under Indian accounting standard, more stringent recognition of deferred tax assets exists. A common pitfall is applying international financial reporting standards thinking to Indian accounting standard. Always remember, rule nuances reflect regional tax strategies and affect financial statement presentation. Apply the tax rate to the timing difference. For $50,000 at 30%, deferred tax is $15,000. Misstep: ignoring changes in tax rates or future reversals. Always tie calculations to current rates, ensuring deferred tax reflects actual financial implications and future tax burdens. Deferred tax liabilities might seem non-cash, but they affect future cash flows. Exclusion stems from misunderstanding their role in future financial obligations. Correctly include them to assess true financial health. Overlooking them risks underestimating liability, affecting value assessments and strategic decisions. Disclosures include reconciliation of tax expense with accounting profit, deferred tax assets and liabilities, and unrecognized deferred tax assets. Missed details distort understanding of financial health. Master these disclosures to provide transparent tax impacts, ensuring informed decision-making for stakeholders. Overestimating future taxable profits leading to unrecognized assets. A $100,000 asset requires offsetting future profits. Misstep: not reassessing assumptions as circumstances change. Always confirm asset realizability, ensuring they reflect potential financial outcomes and align with realistic future profit expectations. IAS 12 focuses on accounting for current and deferred taxes. It applies to taxes on taxable profits, including withholding taxes. Understanding current tax involves amounts payable based on taxable profit, while deferred tax addresses future tax effects arising from temporary differences. Temporary differences occur due to discrepancies between the carrying amount and tax base of an asset or liability. Grasping these core definitions is crucial for accurate financial reporting. The deferred tax model under IAS 12 relies on temporary differences to recognize future tax effects. Measurement involves applying tax rates expected at realization or settlement. Deferred tax assets must be reassessed regularly for recoverability, and offsetting is only possible with a legal right and intent. Adjustments for tax rate changes occur immediately. Remember, deferred tax balances are not discounted to present value. In interviews, avoiding key traps like misapplying temporary differences is vital. A big international financial reporting standards versus U.S. generally accepted accounting principles difference is discounting deferred taxes, which international financial reporting standards does not allow. Disclosure should highlight temporary differences and unrecognized assets. Common pitfalls include ignoring future tax rate changes. Disclosures must also cover significant judgments in recognizing deferred tax assets. Knowing how to handle unusual items can set you apart. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.